Thanks for joining me today. I recently turned 70. I've been reflecting on my 45-year professional career and what I've been doing with it. Thinking about it, I've concluded that all those thousands of flights, thousands of meetings really come down to one thing: chasing an 8% return for my clients. Whether it's an actuarial rate or a rate that supports preserving real endowment value, that 8% number has driven the investment business throughout my professional career. Fortunately, early in my career, consulting to the likes of CalPERS or University of California, the job was relatively easy. Expected returns on both stocks and bonds were double-digit, well above the 8% target for most of the first half of my career, as shown in this slide too. It was hard to mess up, which is good, I guess, when you're learning a business. However, as the year 2000 approached, it became increasingly clear that the stock and bond numbers were adding up to 8%, not individually or collectively. And no relief was coming from a declining actuarial rate or declining spending levels, all which created a investment conundrum as the year 2000 approached. Expected returns on the ubiquitous 60/40 portfolio in this slide 3 dropped below 8% when I was mid-career and have stayed sub 8% ever since. Actual returns on the 60/40 portfolio are shown at the bottom of this slide. That 60/40 portfolio returned a healthy 13.8% annualized up until 2000. But after 2000, 60/40 has returned really a very modest 6.7%. Thinking about it, compounding over 20 years, that 6.7% produces a 25% shortfall relative to the 8% objective. And for example, it's no wonder that public pensions are on average 75% funded today versus 100% back in 2000. Filling a need, investments identified collectively as alternatives came to the rescue around the year 2000. As a side note, my partners and I started Cliffwater around that time as an alternatives advisory firm specifically to help our clients close the growing return shortfall. The map on this slide illustrates a variety of strategies managers have proposed as alternatives, either to boost return on the 60/40 mix or reduce risk. We generally group alternatives into 4 categories represented by the corners of the map here. While risk reduction through safe alternatives or diversifying alternatives can play an important role in a portfolio, the alternatives grouped at the top in the yield and growth corners, led by private debt and private equity, have been key to solving the 60/40 return shortfall. Return-generating private alternatives have performed well since 2004 when our firm was founded. Private real estate, private equity, and private debt have been meaningfully accretive to performance, both absolutely and risk-adjusted. Hedge funds have struggled, likely attributable to their vulnerability to efficient markets, but unlike the private asset classes, which have really performed well since our founding, covering almost 20 years, as shown on this slide 5. We expect roughly the same from alternatives going forward. On slide 6 here, we show our expected 10-year returns for both traditional and alternative asset classes. We expect our industry-leading research and investment offerings, particularly in private debt, will continue to pay off in the future as they have in the past. So again, our expectation is really that the next 10 years will not be too unlike the last 20 years as it regards to private alternative assets. But don't take our word for it. Other top advisors agree. Their expected asset class returns, shown here on slide 7, roughly mirror our expectations. On average and individually, these advisors agree that private debt offers the single best new alternative addition to a traditional portfolio and a good complement to private equity. Well, that's it. 45 years in less than 10 minutes. Thanks for listening.